This is the MTPredictor weekly market update for March 10th. Right, got a lot of stuff to cover tonight. Hopefully I'll be able to get it all in here. Let us start, well, let's start with the Dow, since that one's kind of one making all the headlines for the most part here. Anyway, you can see the Dow, this is the new futures contract, the June contract anyway. We'll look at the Dow cash in a second as well, but you can see the new high there. Here's your previous high back in 2007. We've obviously exceeded that. You know, we were looking for Dow 14,000. If you were watching the weekly market update, we achieved that, and I was looking at 14,000 to 14,100 area, and we've gone beyond that now. So you see the next major resistance here is going to be just starting around that 14,700 area. 15,000 is a nice round number there, and then the top of the resistance area is Dow 16,000, at least on the futures side here. If you want to look at the cash Dow here, courtesy of barchart.com, you can see here's the cash Dow, new all-time high there as well. We looked at the fact that we do have this broadening pattern here. In other words, we're getting higher highs and lower lows, and that's that broadening formation, kind of a reverse triangle. That is a topping pattern, but the top, if we drew the trend line here, would come in around 16,000, and so like we talked about, we've got a lot of room to the upside here. You know, once we took out that 14,000 to 14,100 area. Now if we look at and we'll look at the kind of the reasons behind a lot of this, but let's look at the S&P here. S&P is a little different picture. Now the future has taken out the prior high there back in 2007. All right, so we closed at 1544.50 in the new futures contract there. The S&P cash, we'll take a look at that. So let me just bring this in here. The S&P cash, you can see, has not quite yet taken out that prior high back from 2007. So the cash lagging the futures contract a bit there, which is typical. But we want to see that confirm. And again, if it does, then we still have this broadening pattern in the S&P as well, with the higher succession of higher highs and lower lows. And we talked about, again, that being a potential topping pattern. But also, if we do get this kind of diamond formation, again, it may take a couple years to form, where we get this kind of megaphone or this broadening pattern on this side, and then things begin to narrow into a triangle on this side, so you get that diamond top, which again is a sign of a diamond top as a market top, and implications to the downside there. Typically it does break for the most part to the downside, and those diamond formations can, I think 80-something% of the time will wipe out the whole move up into the diamond. So that would have some very dire market implications if that does form. But again, these are big picture stuff. We'll see what we get here as the markets continue to unfold. So we know the S&P, we talked about the area here. Let's just make this larger. We talked about the area here, this resistance area from 1520 was the beginning, all the way up to 1560. Hasn't gotten through that area yet. Now the Dow has powered through its resistance. The S&P is still in that resistance area. So again, correction could come at any point. Certainly due for a correction, and it doesn't mean that the market won't then continue higher. But we're just in an area you got to protect the long positions. Whatever you've got, 401ks and so forth, that are only built to make money when the markets go up. You've got to keep an eye on the long side. This is probably not an area you want to be buying in. it's typically the amateur traders that buy at you know buy after rallies, and professionals buy on dips, if you will. All right, so S&P not out of the woods yet there. If we can get a close above 1560, and whatever that high is ends up get taken out, then that has cleared that, and we'd be looking at the next level, which would come in around 1655, 56 area would be the beginning of that. Now 1600 here also, just kind of a natural round number resistance area as well, so keep an eye on that. And the NQ has made some progress. It's looking a little better, but of course what we need to see here is you see the wave 2 here. We've gotten a close above that wave 2 resistance area here this past week, but now we need to see that high get taken out to the upside, the high there of 2817. If they can, then they should look to take out the prior wave 5 swing here where the DP is, and we can take our new DP off of this level to get our next resistance there around 2907 would be the start of that, if they can accomplish what we just talked about there. But that's looking better. If they can take that out, then we'll have the markets a little more in sync, because the NQ will be at a high. We know that we looked at the Russell last week. That broke out of an ascending triangle on the weekly, monthly chart, and off to new highs there. And so then we'll have the NASDAQ kind of coming in line there. Now, I think a lot of the run in the Dow, the new high in the Dow, I think it took a lot of people on Main Street by surprise, because unlike in the tech bubble in 2000, a great many people, as the Dow was making highs, felt it in their pockets as well. And but today it's a little different, because even though the average net worth of the person on Main Street has gone up, the average income has gone down. And so we've got some other things in the background coming into play that make things a little bit different. We know that the Fed has pumped all this liquidity in, and this is basically the inflation that is a result that we're seeing in the market of that, and that's liquidity that's being injected by central banks around the world. So but if you want to kind of take a look at some other things kind of behind it, some other charts that I found interesting, let's take a look at some of that stuff. Now, to kind of step back a bit and again go back to why is this happening? Well, we know that the Fed is keeping the interest rates artificially low. They want to keep, and they're keeping their eye, I think their forecast for inflation is at 2.5%. So if inflation creeps up beyond 2.5%, that would be a potentially actionable event for the Fed. But as long as inflation is below that 2.5%, unemployment it remains above around 6.5%, I think is their forecast, then we're going to have these artificially low rates out to 2015, whatever they were talking about. So I think the Feds and the economic forecasts are pretty close there. Inflation this year around 1.8%, and the same I think for 2014. But the interesting thing, we talk about, and I say this all the time, is that when interest rates are low, stocks will grow. And it doesn't mean if interest rates are, I guess, for lack of a better term, naturally low, as opposed to artificially low, as the environment that we're in now. It's clear that when interest rates are low, stocks grow. All right, and if you go back to 1950, I was looking at some data that when interest rates are below 2.2%, which they are now, stocks return about over 13% on average. When when interest rates are above 5%, stocks only return about 0.5% on average. So that's one of the ingredients here that's making up this. This is why we're seeing, all-time highs in the Dow. Why we're experiencing things that seem like they'll be contrary to what the economy is telling us. But a lot of this is based on interest rates. The other thing that was interesting, Warren Buffett purchased Heinz stock, and I think the PE was like above 21 or something, and it kind of made you scratch your head and say, gee, what is Warren Buffett seeing a stock with a PE of 21? Where's he seeing the value in that? And again, if you go back to 1950, again with interest rates, when they're below 2.5%, the average PE in the stock market during those periods is almost 22%. And when interest rates are above 6%, the PE ratio is around 12%. And so I think the PE currently in the market is about 17.5%. Right. So if typically on average, given the fact that interest rates are below 2.5%, PEs can be almost 22%. That would be today, basically, we'd be a little undervalued. So these things are kind of what's fueling why we're getting what we're getting here in the stock market. And we can look at other things. In fact, let's just look at, here was a chart from Gary Schilling, an economist, that kind of puts things in perspective. And so here's the S&P 500. This is the nominal S&P. In other words, it's not factored in your inflation and expenses and things. And you can see that's in this bull market. But if you look at the S&P adjusted for, in this case, is it deflated by the CPI? If you take out the inflation, you can see that the S&P is actually in a bear market. We get lower highs and lower lows here, and so it kind of puts things in a little bit of perspective, gives you a little food for thought. That even though the market is moving higher, and the Fed is trying to, it's part of what the Fed was trying to accomplish: pump all this money in, fight that deflation. And he's hoping that the stock market is one of the things that he and Greenspan before him said would not allow to be the straw that breaks the camel's back. But the Fed also said, Bernanke, when this whole thing started back in 2008, that it was real estate that got us into this mess, and effectively it needs to be real estate to get us out of this mess. So they probably were looking to create a bubble in real estate, at least get real estate prices moving higher again as well, and try to accomplish what in his mind they failed to do during the Great Depression, which was obviously a deflationary depression. So they're battling that deflation here and pumping these things up in the hopes that eventually they'll gain traction on their own, the economy will improve, and we can get out of this mess. Can that be accomplished? Well, I guess we have to wait and see, but that's the other reason why gold and silver are moving higher. It's a hedge against basically the Fed not being able to accomplish what he's setting out to do here. All right, so we can take a look at gold and silver here. Okay, so here's the chart of silver, the weekly chart, and you can see the price of silver had come down. It's about 28, just under $29 an ounce. It's been down here before. You can see this base of this larger descending triangle here in this case. Is that basically you're at some support here. So it's a potential area for buying, but you can see we have succession of lower highs here, and that's as it's getting towards this apex. Typically these lose strength the further out they get into the apex here. So a break will come one way or the other. This is being a descending triangle. Typically the break is to the downside. So I won't be surprised if they if we do get a break to the downside. In fact, I was looking, obviously in 1980, gold hitting highs there at $800 and silver at $50 an ounce. But before that, if you go a little before that, in 1976, I think gold had lost some 40 something percent, and people were basically writing it off and saying, the gold bull was over. I was looking at some information from the New York Times and the different analysts and stuff. But there were a few lone voices out there that were taking that opportunity on that when gold got smashed to buy, and they were having their clients buy. And of course, they were the heroes, I guess, at least to their clients, because gold then went on a run from 76 to 80, to $800. So I wouldn't be surprised to see that type of action again if we get some type of real correction. And we can take a look at gold here as well. That really kind of weeds out the weak hands, if you will, as it did in 76. So here's that same, basically your triangle coming in here. We're at the support. Here's your 200 period moving average. Again, we've seen that back in 2008 when the stock market crashed. Gold just pierced that 200 period moving average there. So I wouldn't be surprised to see a break below this area. Again, we can chop inside the trend lines here as things narrow into the apex. The earlier this does break one way or the other, probably the more power it has. If it takes longer to do that, the less power it's going to have, and maybe a lot of fault signals and breakouts and stuff happen. But wouldn't be surprised to see if, especially this decoupling, where people feeling that the markets are at all-time high, therefore those people that were buying gold and silver because they thought the market was going to crash, and now that that has reversed, they don't need to hold gold and silver. That's really not the point. But if there's that type of action going on, then I wouldn't be surprised to see if we get that deeper correction in gold to the 200 period, maybe even beyond that. So we'll see. Just some, again, food for thought, and we'll see how things shape up. So we covered a lot of ground there. Some other stuff I wanted to get to, but I guess I'll save that for next week. Look at the bonds again, and interest rates, and the euro and the dollar and so forth. So we'll end it there. Hope you have a good trading week, and we'll be back at it next week.